Good morning, dear investors. I'm very grateful for your time and interest to Artea Group meeting, webinar. And today we'll be happy to present our 9 months financial and other results and key developments. So let's get started. So key financial and strategic highlights. We can start with net profit generated. So 48 million euros net profit for 9 months. If we count adjusted to some one-offs that we are counting during those years, the result would stand at the level of slightly more than 56 million. Return on equity 11.1 and 13% respectively. And other parameters you also see in the slide. So I will run through the key highlights just to emphasize the most important elements of financial and other developments. So net interest income grew by 6% quarter on quarter, so rebounds from the previous quarter. And it was supported by the stable NIM. Overall credit portfolio dynamics looks good in all sectors. So the economic situation positive. So we have pretty good development in the loan book. Net fee and commission income is also grew by 8% year on year. So stronger performance than expected in our budgets, which was driven by also strong renovation financing, asset management performance, and other income lines. We tried to keep the stable operating cost despite that we had one-offs, and we have investment in our strategic projects like rebranding and also our technological platform. Therefore, the cost management is key in our agenda as well. Asset quality, mainly our loan book, is performing really well. The NPL ratio slightly above 2%, so it's pretty good level of NPLs and other parameters. So impairment levels we received even reversals during the quarter. If we count on solo level, net profit for the third quarter was close to 20 million euros if we take adjusted profit. And this is close to our yearly indication of our profit and return on equity guidance, and stood at the 13.5% for the third quarter of adjusted net profit. We started a very interesting strategic partnership with Kauno Žalgiris. So I'll give some more highlights in the next slide. So not talk too much now. Another area which already was mentioned, but also to emphasize about the cost optimization. So we're looking for different type of opportunities to get more efficient with our cost base, knowing that the top line is lower due to the Euribor developments, cost of funding. So cost efficiency and cost slimness is one of the priority for the forthcoming quarters as well. Successful issuance of 300 million euro senior bonds, which continues to diversify our funding structure, and also we were happy about the very strong investor demand for this issuance. As well, we're happy with Moody's reaffirmed rating with a stable outlook, the AA1, and they're highlighting our strong performance with parameters like capital and liquidity. And last but not least, share buybacks. We have resumed this program. We've already executed part of that, so the next part will be executed in the future. So we are, as before, utilizing all the elements to work efficiently with our capital base. Well, a few words about our strategic partnership with Kauno Žalgiris. So basketball overall in our country, we treat it as a second religion. Therefore, to cooperate with top-notch basketball brand as Kauno Žalgiris is a privilege to us. It's a really nice and well-structured partnership. So we will be visible in most of the events and both internationally and locally, since Žalgiris also plays in EuroLeague. So as you can see, the 8 of 10 Lithuanians are interested in basketball, and 76% supports Kauno Žalgiris, placed outside the country. So the recognition of this club is very strong, and I hope each Lithuanian proud that we have such a strong team in a universe of other basketball players, basketball teams, and performs really well. So along with all the communication, we also launched co-branded credit and debit cards with different type of benefits for the fans who are willing to acquire. So also advertises those cards for all those who are willing to support Žalgiris and be a real fan. And with that, for the bank, we see that we will increase our brand visibility, since the brand is still pretty new and we need more awareness for this brand. The development is really good, but with such a partnership, we will reach really high levels. With that, we also amplify our positioning, supporting such a strong brand as Kauno Žalgiris. We want to emphasize our closeness to the clients, closeness to the Lithuanian people, and also naming that we are a local band, we're willing to be the local champion in the finance industry. With this also, we expect to attract new clients, since we have different type of clients, and we're willing to gain more younger and higher value retail clients. So with this campaign, with this positioning of a product, we will hope to achieve that. And definitely that will be also additional expected stream from the co-branded cards related with this co-branded proposition. So that's it from my side. I will pass the word to my colleague Indrė. She will present macroeconomic of Lithuania and around. Please.
Thank you very much. Good morning, ladies and gentlemen. Thanks for sparing time and spending it with us. What's on macroeconomic perspective? Actually, it is wonderful to talk about Lithuania's economy, to look into retrospective and to see how strongly fundamentals of our economy look, because last year our real GDP increased by 3%, and Lithuania continued on a rapid pace this year. In the first half of the year, our economy even gathered the pace and grew by 3.2%. and stood out among the European Union countries according to the growth rates. And also in the context of the Baltics, Lithuania outperforms other neighbors and proceeds growing rapidly. However, we expect Lithuanian economy to slow down in the second half of the year, and the main reason is the weaker external drivers, weaker manufacturing performance, and all in all, we expect the Lithuanian economy to grow by 2.7% this year. However, the next year, Lithuanian economy will gather the pace once again. It is interesting to look to the structural breakdowns and to see how the major economic drivers have shifted. Actually, at the moment, since the beginning of the Russian invasion to Ukraine, we see that the traditional economic activities such as transport, manufacturing, and domestic trade have been slower. However, Lithuanian economy has been driven by those high value added economic activities like information technologies and computer science, also business services, finance, and insurance. So this transformation, this structural transformation is taking place here in Lithuania, and hopefully it will well proceed in the future, because Lithuania should transform and should well translate into the higher value added economy. On the other side, Lithuania is also very energetic in the cyclical upturn because we capitalized a lot on the lower interest rate environment as the European Central Bank reduced interest rates, normalized to them. Lithuanian credit market gathered momentum, and as you can see from the right-hand side diagram, Lithuania tops the rank of European Union countries according to the loan portfolio dynamics. The middle graph illustrates that loans granted to non-financial corporations have been expanding at an accelerating pace, and in September, the portfolio was by a fifth higher than a year ago. The credit injections into households sector also was really dynamic, and the portfolio growth was also high. So the cyclical recovery, cyclical upturn stimulates local sectors cyclically more sensitive, and also adds to the economic strength and to the stronger performance of the domestic demand. Despite the really dynamic credit market, we see that the indebtedness levels of Lithuania still remains among the lowest in comparison to other EU economies. And also it is useful to stress that the quality of loan portfolio is excellent despite the interest rate environment changes. What is also is interesting and useful to tell is that currently our state budget plan for the next year is presented, and Lithuania is sticking to its targets to increase its defense spending really significantly. And exceed 5% of GDP, and actually Lithuania is walking the talk and planned to fulfill this target the next year and the following years. And that's only a natural and positive signals to both our defense partners as well as our potential foreign investors and local businesses. Moreover, talking about the next year, we increased our forecast significantly up to 3.3% in terms of GDP growth, because the next year we will see a lot of positive tailwinds for our economy. First of all, accommodative and socially oriented fiscal budget for the next year is planned. Moreover, the second pension pillar reform will kick in and also stimulate domestic consumption. And last but not the least, the Bank of Lithuania has introduced changes to responsible lending regulations, which also add fuel to real estate housing market. So last but not the least, also EU funds are planned much higher than we used to have in recent years. And hopefully defense money will not only go abroad, but also find the way in a form of investments here locally, creating room for multiplicators, local multiplicators. And the final slide is the summary of what I have said. First of all, we expect slower growth in the second half of this year. The next year, Lithuanian economy will have a much faster economic performance as a result of one-off factors, as well as pro-cyclical fiscal stance and positive upturn of the business cycles. So the results, macroeconomic results, will be very positive. However, in 2027, it won't be easy to to outshine them, and that's why we expect a bit slower economic growth. So thanks a lot, and I giving the floor to Thomas.
Yes, hello everyone. Thank you, Indra, and let's continue our webinar with our financial performance during the Q3 and the 9 months of this year. So to begin, a general overview of our performance in income statement and balance sheet. So on the top line, our net interest margin or income stabilized, and even by slow growth of our loan portfolio, but together with active management of cost of funding, we managed to increase our net interest income by 6% quarter on quarter. Net fee and commission income supports our revenue generation and shows a high growth, 8% year on year. Quarter on quarter, we deliver sustainable growth, and it's well supported by renovation and asset management business. Capital markets business also delivering a good contribution to our net fees and commission income. On OpEx side, we remained with flat operating expenses, and only our strategic investments brings the growth of operating expenses itself. As said during the last our webinar, we are taking comprehensive review of our cost base, and we'll elaborate on that topic a little bit later. On the bottom line, we achieved a strong result, 16.5% of net profit for Q3. And even if we take out the one-off expenses, we are close to 20 million euros for the Q3 and 13.5 ROE for the quarter. Our loan book expanded by 8% year on year, and deposit portfolio by 15%. So we are happy that our focus on increasing deposit portfolio and bringing our loan to deposit ratio below 100% was quickly implemented. And going forward, we believe that our deposit portfolio growth will match loan book expansion. So going forward more deeply into some important segments. So starting with a net interest income. Yes, we are operating under a declining rate environment, but we do see that our asset yield already repriced with declining Euribor, and going forward, we expect that by taking flat Euribor performance, it will keep asset yield at the same level. We are actively managing our cost of funding, and it's nicely decreased during the last quarter, mainly by repricing of our deposit portfolio. Going forward, as we have issued a new bond issue, so cost of funding should remain at more or less the same level. Additionally, we have introduced hedging instruments, and it will reduce our sensitivity in case the rates gonna decline in the upcoming quarters. Looking to the fourth quarter or upcoming quarters, so we do expect still that our net interest margin should end up at 2.8 or 2.7%. Let's turn to the loan portfolio. So our loan portfolio increased by 8% year on year, and the key segments that contributed to the growth is corporate and mortgage segments and consumer. The overall credit demand is good in the country, and it's well supported by the macro environment. During the last quarter, we have slower growth in corporate segment. The reason is that in July, we had a couple of large exposures that we are refinanced, and the amount of these refinancing was close to 100 million euros. So we had to run fast in order to catch up with our growth rates for the quarter and for the whole year. We believe that we can bring our loan portfolio growth rate in the area of 13 or 14% for this year. Net fee and commission income, good growth, mainly contributed by asset management and renovation segment. Asset management fees are supported by the strong financial market performance. Our fund management team is delivering top-notch results compared to the competitors. Renovation segment performs well. We keep being active by originating these loans, and we're working to launch additional funds in order to keep that business line performing well in the coming quarters. The decline in daily banking was actually driven by one-off or one-time costs that were related to rebranding, as we needed to change some of our products into a new branded ones. In overall, our net fee and income contribution to the total revenues is nicely increasing and is close to 15% of our total revenue. Let's turn to the operating expenses. So we had a good development in Q3 by taking out the one-offs. So our operating expenses are stabilizing. Salaries, IT, marketing, buildings, more or less flat. Our other expenses increased by 1.3 million. It's twofold effect. The one is we have changed accounting of our digital authentication expenses from the IT to the other ones, and we had 0.5 million of one-off non-recurring expenses on corporate development that won't be in Q4 or going forward. And one-offs, so we are implementing our strategic initiatives, rebranding, our technological upgrade is underway. Rebranding is already finished, and in Q4, only minor expenses still will be accounted as one-offs, but technological upgrade, it's still in progress. We are midway, and as launch is expected mid next year. So we'll still be investing in that strategic initiative. On cost-cutting initiatives, as it's very important for us as organization, as our top line is lower than we have anticipated. So we have already started implementing the measures in the Q3. We have changes in the management board. So we have streamlined the structure and the responsibilities of the management board. We're still working on consolidating the leadership roles and finding the best way in order to support our strategic priorities going forward. We are underway on optimizing our operational structure. We have merged two divisions in Q3 and working forward in order to bring the organizational structure even into the more efficient way to operate the business. And we are undertaking a review of our non-core initiatives. So we have paused initiatives that are low impact and are not supporting our strategic goals. And actually, we are taking zero-based budgeting. So in order to put all the expenses that the organization is bearing, that to have the background in order to deliver the guidance that was communicated to our shareholders. Going forward to asset quality, so it's performing well. Quarter with reversals, and it's well supported again by the macro situation that we're having in Lithuania and our discipline underwriting of the loan portfolio. We have implemented significant increase in credit risk rule. So we had reallocation of part of our portfolio from stage 1 to stage 2. So we have increase in stage 2. We are doing that to meet the best practice. And during the last couple of years, we implemented many methodological changes. How do we provision? How do we make impairments? And how do we monitoring our loan portfolio performance? We believe that we are at the end point of doing these changes. So going forward, we do not expect that it will be a driver on our impairments or cost of risk. So in overall, we're happy with our asset quality. Cost of trailing 12 months cost of risk stands at 22 basis points. The last quarter, the 9 months of this year, cost of risk is 14 basis points. We do expect that, given the macro situation in the country, that these levels are sustainable in upcoming quarters. On the funding, so we do have a nice development and a nice quick development, as we have highly refocused in building our liquidity during the second half of this year. So from the beginning of the year, our deposit portfolio increased already by 8%, and year on year it's a 15% growth, a good growth, and we are still able to decrease our cost of deposits. Going forward, we believe that the decrease, the rate of, or the pace of the decrease will not be so significant as we do see that term deposits, that a product that we promote in a country is a good product to build liquidity, and it's a good product as an entry product for our retail clients. We have issued the second Eurobond issue, 300 million euros, very well received by investors, and we took a chance or opportunity by having very favorable market conditions. So we have secured our wholesale funding for the next year, and we will keep fully focused on growing the deposit portfolio during the last quarter and the next year. Let's turn to the capital. We ran strong capital ratios. Given the slower growth rate for this year compared to our initial budgeted levels. So we have a capital that the management will consider for higher payout potential ratios for the 2025 year. So giving a word to Todd with us to elaborate more on our shareholder returns and capital distribution.
Good morning, everyone. Thank you, Thomas. We have resumed our share buyback program earlier this month. Starting from 6th of October until now, we repurchased close to 1.2 million shares. And under the current ECB authorization, we can buy up to additional 3.3 million shares, which we fully intend to do. And we will restart our share buyback open market operations in the near future. Overall, we view share buybacks as a very effective way to return capital to our shareholders, given the current trading levels. Our stock continues to trade below book value and remains significantly undervalued. And as long as that remains the case, we'll always stand ready to deploy buybacks. We're a shareholder-friendly institution. In addition to buybacks, we pay a generous dividend, which we'll announce next quarter, whilst at the same time prudently managing our capital needs to support organic growth. Our book value per share keeps compounding steadily quarter after quarter, as you can see from the chart at the bottom left-hand side of this page. And we believe that our share price should start reflecting that over time. To wrap up today's webinar, I wanted to say that it was a solid quarter despite the ongoing top-line pressures as we continue to operate in a low-rate environment. We remain focused. We continue executing on our strategy. Our core banking replatforming project is progressing well. We said it last quarter. I'm going to repeat this quarter again. The project is within the budget and on schedule. Our rebranding has almost been complete. It was very well received by our customers and other stakeholder groups in the country. And we continue transforming our retail business. We're very glad and excited about this new partnership with Kauno Žalgiris, which is the most famous sports club in Lithuania and will help us to unlock and access new customer segments. Now, in terms of this specific quarter, I want to leave with a few key takeaways. Number one is that our NIM is stabilizing and our net interest income increased sequentially quarter by quarter. Number two, as we're proactively managing costs, I'm glad that our operating expenses are normalizing when you exclude one-off, non-recurring project-related items. And then finally, we delivered adjusted net profit of 19.5 million, which equates to ROE of 13.5%. Very strong and solid result for the quarter. I want to reiterate that we're a shareholder-friendly institution, which is committed to open dialogue and transparency. And we want to continue building connectivity with our investor community. As a result, we're going to be on the road in Q4 a lot, as you can see from our busy investor relations schedule depicted on this slide. We're going to be participating in a number of retail-focused conferences across all three Baltic capital cities. And we're also going to be participating in a number of institutional investor events. On November 17, we're going to be in London participating in Goldman Sachs annual CMA conference. And then on December 2nd, we're going to be in Prague participating in Wood's Winter Wonderland conference, which remains the flagship event for equity CMA investors. As always, the management team is available for follow-up discussions and one-on-one meetings. If you have any questions, feel free to reach out and arrange a call. And this concludes our prepared remarks for today. Thank you for dialing in and thank you for your continued interest in our stock. We will now switch to Q&A. First question is about rebranding. How was it received and whether you have any tangible measures?
Yeah, thank you, Tautvydas. I can take this question. So overall, I would say the rebranding went really smooth. And as you also mentioned, it was pretty well accepted also in the country and outside. Our targets were to regain as soon as possible our awareness of the previous brand. So we're very moving successfully in that path. So our brand awareness now is in the level of 51%. So the historic of Šiaulių Bankas used to be 81. So we thought it would be half, that would be really good results. So we already overcame this, our target. And I'm sure we will reach the same level in the future. Also worth mentioning that our spontaneous awareness has already reached 15%, it's almost on the same level as Šiaulių Banko spontaneous awareness in January of this year. And with that, we also all became such a banks as Urbo, Citadel, and also Revolut. And our top of mind awareness as well is on the same level as our previous brand name. And also we overcame Urbo, Citadel, and on the same level with Revolut. So I'm really happy with those results. And also the other area which is important, that we're now attracting also new type of clients, which are much younger, slightly higher income. So that's our focus on using the new brand to position ourselves a bit differently. So overall, I would say it's a successful project that we've managed to complete.
Great, thank you. The next question is about the upcoming Pillar 2 pension reform in Lithuania. How will new reform will affect your asset management business?
I will take that question. We believe that it will be twofold effect. So from business development and business growth side, we think that it will have a positive contribution to our performance, as the activation of a client base will be high. So we will be able to talk to the clients to discuss their long-term saving needs and to offer our saving products to them. From our side, so absolutely, in case there will be a high withdrawals from the pension funds, so there will be a negative financial impact. But as I said, we are seeing that as an opportunity to discuss, to talk with clients, and to mitigate the negative effect with a positive opportunity to sell our products to the clients.
Great. The next few questions come from Swedbank. Good morning, Andrea. Question about the loan book growth. Can you please provide additional color on your quarterly growth in loan book? The report shows that corporate loan book growth was a little bit slow. Was it deliberate, or do you feel increased competition? And can you share additional details on that?
Thank you, Andrew, for the question. Already mentioned that in Q3 we had refinancing on a couple of our larger exposures, so we had to catch up with the growth. So that's why we had only 1% growth rate for the third quarter. But you do see a good environment, strong demand for loans. So we believe that Q4 will be our normal loan portfolio growth, and we expect our 2025 growth rate will end up at 13 or 14%.
And then the additional question from Andre is, can you please indicate when is it reasonable to expect a little bit more tangible effect on deposit repricing and have lower rates?
So we already see tangible effect, and the dynamics is good. Even during the Q3, our cost of deposit decreased by 20%. We believe that the pace of decrease of cost of deposits will decrease as we proactively promoting our term deposit as a product, as it's a good entry product for our retail clients into the bank.
The next question comes from Artea. Good morning, Thomas. What are your expectations for NIM, net interest margin, in the coming quarters? How do you expect asset yields and funding costs to develop over Q4 and the following quarters?
Yeah, I will take that question. Good morning, Thomas. So our Q3 net interest margin stands at 2.9%. We expect 2.8, 2.7 level for the upcoming quarters. Mainly the decrease will be driven by our cost of funding. We believe that assets already repriced, and it won't change significantly in the upcoming quarters.
Thank you. The next two questions come from Ipopema. Good morning, Vladan. Did you have rebranding costs in Q3 marketing expense line item. They seem to increase a lot in Q3.
Good morning, Gladden. Yes, correct. As rebranding took place mid Q2, so the majority of the marketing expense on building our new brand costs came up in the Q3, and then only minor expenses will be booked in the Q4, and going forward, only the would say operating marketing costs or normalized marketing costs will be spent.
Thank you. An additional question from Gladden is about the deposits. Deposit growth was strong, plus 15% year-over-year, while funding costs declined. Is this improvement mainly driven by term deposit campaigns, or is it driven by lower rate environment? Where do you see your deposit rates in 2026?
So our deposit portfolio is growing nicely, 15% year-on-year, faster than the market. Yes, our funding costs are declining, so it means that we are not only building our deposit portfolio by attracting term deposits. We do have a good flow of current accounts into the bank, so it means that more and more clients chooses Artea as a home bank. So we believe that going forward, we will be able to match term deposits growth together with the current accounts growth. And deposit rates for 2026, we believe that we will slightly decrease. One of the key reasons we think that the second pillar pension reform will bring more liquidity into the market, and that will be a driver for the financial sector to lower the rates.
Great. The next question is about non-recurring expenses. One-off costs for the new core banking system and branding remain high and seems recurring on the face of it. How long will we see these investments continue, and when we should expect a visible decline?
Yep. Hello, Dallas. So I will continue. So rebranding, as I said, the project already finished, and the costs already are visible in our performance. Only minor expenses will be in Q4, and going forward, only the operating or normalized level of the marketing will be spent on a core banking system. So it's a 2-year project for the bank. We are midway. The project itself is still in the timeline and within the budget. So during the next year, our investment into the technological platform will continue, and that's what we have in our business plan and in the guidance.
The next question is about the new partnership deal. Regarding Kauno Žalgiris partnership, how do you measure its potential commercial impact? Have you already seen any gains in new customers, co-branded product sales?
Yeah, thank you for the question. And yeah, this is a corporation which provides both new client acquisition and also the brand awareness. So client acquisition is based on co-branded cards. We have a partnership with Žalgiris and some revenue sharing. So the expectations are we have internal targets when we know that this campaign will repay. But I would say the main emphasis is for the attraction of the new clients for the bank, new segments of clients, and the main focus to strengthen our brand awareness for this partnership. So there's our focus, and co-branded product is part of that. As also Thomas mentioned, it's important to emphasize this partnership is already outside of our one-off costs. Talking about rebranding, so it will be just running marketing costs for the coming years.
Okay, and think we had the last question about our capital management policy. After resuming share buybacks with ECB approval, what's your long-term capital return strategy? What payout ratio, buyback pace do you plan? Profitability increases and stabilizes?
We have a dividend policy in place. We as organization committed to at least 50% of dividend payout. So it's what we as organization will follow. On buybacks, so it will depend on the valuation the bank stock is trading, and on the capital position the bank is running. Looking to the current situation, as the growth rate for this year was lower, we will need as a management to reassess the capital that was not employed to the growth. What is the best way to utilize that? So either to bring that to the growth for the next year, either to distribute it for the shareholders.
Thank you, Thomas. And that was our last question. As always, we're available for follow-ups and one-on-one discussions. Feel free to reach out if you have additional questions after this webinar. Thank you again. Bye.